Hey everyone, and welcome to this explainer. Today, we are setting the stage for an exam-ready masterclass on the inventory cycle. Look, if you've ever felt completely overwhelmed by the sheer volume of documents, financial assertions, and controls involved in auditing inventory, you are definitely in the right place. We're going to break down this massive topic into clear, logical steps. By the end of this, you'll know exactly how physical inventory flows through a business, and more importantly, how we control and audit it. Let's get into it.
Okay, let's anchor our entire cycle in top-level corporate governance. Before we even think about looking at a warehouse, we have to remember that without a solid board-level risk framework, like the one recommended by the King V report, all your lower-level controls will eventually fail. Think about it. If the tone at the top is weak, or if there's literally no risk committee identifying threats like theft or corruption, well, your factory floor controls really aren't going to save you.
So, here's our roadmap for today. 1. Cycle fundamentals and governance. 2. Warehousing, custody and storage. 3. Production, controlling the costs. 4. Dispatch, releasing the inventory. 5. Inventory counts and verification. And finally, 6. IT controls and master files. Section 1. Cycle fundamentals and governance. For a lot of businesses, inventory is their single largest asset and the biggest driver of their gross profit. That makes it a massive target for theft, right? So to control that risk, modern businesses use a perpetual inventory system. Now, understanding this is absolutely crucial. Every control we talk about today relies on knowing exactly what should theoretically be in our warehouse at any given second. Think of it kind of like your banking app. The app shows your theoretical balance, but counting the actual cash in your wallet, that's the physical reality. If your system says you have 100 boxes of raw materials, but you walk onto the floor and only count 90, well, that discrepancy is exactly what triggers our detective controls. Section 2. Warehousing, custody, and storage. I want you to imagine the physical warehouse as an impenetrable fortress. Notice how the receiving and dispatch areas are completely physically isolated from the main storage areas. This is a perfect example of enforcing strict segregation of duties. You literally never want the person accepting goods from suppliers to also be the person packing them into customer trucks. Why? Because that creates a massive opportunity for collusion and theft. A properly designed warehouse uses physical walls, restricted roller doors, and cameras to make sure inventory only flows in one heavily monitored direction. Now, for your exams, you absolutely must memorize these warehousing functions and their corresponding paper trails. When goods arrive, the receiving clerk does a blind count and signs the delivery note. From there, a sequentially numbered Goods Received Note, or GRN, is generated. This GRN is your ultimate proof that inventory actually entered our fortress. Later on, when goods need to move out to the factory floor, we use a material issue note. The golden rule you need to remember here is no physical movement of goods happens without a corresponding paper movement. Period. All right, let's break down this matrix because this is prime exam territory. We're mapping exactly what can go wrong to the specific defense, the objective, and the financial assertion. Say inventory gets stolen. Your records will overstate what you actually have, which violates the existence assertion. To stop this, physical barriers. What if a clerk just forgets to record a transfer? Now your inventory records are incomplete, violating completeness. So we mandate signing sequenced GRNs. Auditors can just check the numerical sequence and instantly spot a missing document. And finally, if we accept 80 boxes but the supplier billed us for 100, our valuation is totally wrong. We prevent this by mandating strict blind counts right at the receiving bay. Let's contrast a human signing paper with an automated scanner logging a digital fingerprint. In a manual system, human error is, frankly, pretty high. Paper GRNs can easily get lost or altered. But picture a computerized system. An employee scans a barcode on the loading dock, and bam! Instantly, the perpetual inventory master file is updated, the exact time is logged, and the system automatically cross-checks to see if the delivery actually matches the original digital purchase order. It's a game changer. Section 3. Production, controlling the costs. We're moving from simple storage onto the factory floor, and this is where cost accounting gets highly complex. Think of this linear flow as the life cycle journey of a product. Every single step here requires specific authorization and tracking. We don't just, guess what to build. Production is driven by an authorized schedule. Raw materials are requested via a requisition form, they get transferred, goods are manufactured with labor hours strictly tracked, and finally, the finished product is sent right back to the warehouse fortress. Just like in warehousing, the production floor relies heavily on specific documents to capture this transformation from raw materials into finished goods. Production schedules dictate exactly what gets made, so we don't overproduce and waste resources.
Job cards track exactly how many hours of labor went into a specific batch. And when that batch is done, the transfer to finished goods note formally shifts the asset back into the custody of the warehouse manager. Listen closely here. This specific document is what shifts the financial value from work in progress back to finished goods on the balance sheet.
Let's unpack this production matrix. I want you to pay special attention to how variance analysis acts as the ultimate detective control for the valuation assertion. If workers request way too much raw material and just spoil it, our inventory valuation gets completely skewed. If labor costs are allocated incorrectly, we might accidentally underprice our products and bleed money. By having a production manager perform regular variance analysis, basically comparing the standard budgeted costs to the actual costs incurred, we ensure that the accuracy, valuation, and allocation of our inventory on the balance sheet is dead on.
Notice how upgrading to a computerized system removes human math errors entirely. It relies on the strict accuracy of the master file cost data. In a manual setup, you've got a clerk calculating wages and material costs by hand, which opens the door for massive valuation errors. But in an automated environment, the system reads the raw materials transferred, looks up the fixed standard cost in the master file, and instantly processes the journal entry, moving the value from raw materials straight to work in progress. No human math required.
Section 4. Dispatch. Releasing the inventory. Our inventory is finally ready to leave the fortress. This is where inventory turns into revenue. The absolute biggest threat here is accidentally giving inventory away for free. So these documents ensure goods only leave the building if a sale is perfectly recorded. First, pickers use a picking slip, which is generated directly from an authorized sales order to gather the goods. Then, a delivery note is created. The customer absolutely must sign this note upon receipt, because once signed, that delivery note triggers the creation of the sales invoice. Okay, watch out for the classic exam trap here, mixing up your assertions. Remember that a missing invoice impacts the completeness of revenue, not just inventory. If we ship goods but forget to invoice the customer, our revenue is incomplete. The manual control for this is having an independent clerk regularly match all delivery notes to invoices. Now, if wrong items are picked, the customer is billed incorrectly, which impacts the accuracy of debtors. An independent double check of the picking slip before shipping prevents that from happening. This right here showcases the sheer power of IT integration. One click in a computerized system performs the job of 3 different manual clerks instantly. Instead of someone manually writing up a sales journal and an inventory journal and a debtor's ledger, the dispatch clerk simply clicks confirm on the verified on-screen picking slip. That's it. The system automatically reduces the inventory master file quantity, raises the customer invoice, and updates the general ledger all at once. Section 5. Inventory counts and verification. Now that we know how inventory moves, let's explore how auditors actually verify it exists. This is where theory meets reality on the warehouse floor. Understanding the difference between cycle counts and year-end counts is vital. A healthy perpetual inventory system relies heavily on continuous cycle counts. This means counting high-value items maybe weekly, or counting a different aisle every single day. It lets management catch theft or system errors immediately. The year-end count, on the other hand, is a massive coordinated freeze of all operations to confirm the exact balance sheet figure for the auditors. If you only take away one thing for your exams today, memorize the directional testing on this matrix. If you want to prove existence, meaning you want to prove the inventory on the balance sheet isn't just a ghost, you start at the inventory records, the sheet, and walk onto the floor to physically find it. That's sheet to floor. But if you want to prove completeness, that everything sitting in the warehouse is actually recorded, you pick a random physical box off the floor and trace it back to the system. That's floor to sheet. And while you're doing all this, you're constantly looking for dust or damage, which tests the valuation assertion. Section 6. IT controls and master files. Finally, let's talk about the invisible digital layer that protects your computerized accounting application. Because honestly, if the system is compromised, all those physical controls mean absolutely nothing. A warehouse manager might hold the physical keys to the building, right? But they should never, ever have the digital keys to alter pricing on the inventory master file. This is digital segregation of duties. We use access control tables to ensure that a warehouse clerk has read-only access to check stock levels, but the system strictly denies them write access to change quantities without an authorized adjustment form. And every single master file change must leave an automated audit trail. So I'll leave you with this question. If your automated system processes thousands of transactions flawlessly, but the warehouse manager just shares their system password with the dispatch clerk, does your fortress still stand? Think deeply about that vulnerability as you prep for your exams. Remember, no computerized system in the world can outsmart a breakdown in human segregation of duties. An audit is truly only as strong as the integrity of the people executing the controls. Review these matrices, really understand the flow from the document to the assertion, and you will totally master the inventory cycle. Thanks for joining this explainer. Keep learning and stay focused.